Hey everyone, Dalton Grados with Grados Capital here. Now, I know on this channel we talk a lot about day trading, but want to shift from that for this video and talk about how the average person who's, doesn't know a lot about trading, doesn't want to get too much into it, can actually generate passive income from the markets. Now, this would be something that you would want to implement for larger accounts, right? So a larger investment account, even retirement accounts, accounts that you might, want to hand over to a financial advisor. Well, just by knowing what I'm about to teach you in this video, you can actually take those accounts into your own hands. And don't worry, there's no risk involved. We're not going to risk losing all your money. But what we are going to do is implement some simple concepts to where you can actually generate passive income from the markets, and it doesn't require a whole lot of knowledge. I'm going to teach you everything in this video. So with that being said, again, this is for larger accounts, several $100,000, again, like a retirement account. And so let's say you have that all in cash, right? Well, what would a typical advisor advise you to do is always to buy and hold, right? Just buy the market, buy the S&P 500. It goes up over time, hold for the long term, and just do that. Well, that's great. That's great advice. Of course, if you do that, you will over time generate positive returns. But how can we actually be more effective than that? And how can we actually not only be more effective, but generate income every month, generate a monthly paycheck while we are implementing safe methods? So what we're going to do is something called the wheel strategy. Now, the wheel strategy involves using options, and I'm going to assume that you don't know anything about options, so I'm going to explain everything to you. But what we are going to do is we're going to take that, let's say you have $400,000, we're going to take that pile of cash, and we're going to sell what's called a put option on the market. So this is SPY. This is the ETF ticker for the S&P 500, right? Something that you would ordinarily buy and hold. Instead of buying and holding it, what we're going to do is we're going to go into our options chain. Now, don't be confused by this. I'm going to break it down. First of all, what is an option? Well, you have calls and you have puts, right? Calls are when you're going to buy them when the market's going up. Puts, you're going to buy them when the market's going down, right? Now, what we are going to be doing is actually selling the options. So what does that mean when we sell the options? It basically means that we are selling a contract that says we have the obligation to buy the shares of this stock or of the S&P when it reaches our strike price of the option, right? So it might sound complicated to you if you've never heard of this before, but I'm going to try to break it down the best I can. So what we're going to do, it's basically like selling an insurance contract, right? So if you think of it that way, it's a lot more simple. So if you are selling insurance, then you are selling a policy to someone, and they are paying you a premium for it, and they might pay you every month a premium, and you just collect that money. But then when they need to make a claim, then you will, of course, need to pay the claim as the insurance company. But as you'll see here, when that time comes, it's not actually any risk to you. So let's go ahead, and so these are all dates here of the options, right? So let's go ahead and say we want to do this on a monthly basis, generate a monthly income from our $400,000 account. So it's May 25th. Maybe I go down to the June 30th expiration. So these dates all represent the dates where your options, your contracts, are going to expire. All right. So say I want to go in here. Okay. Now these are all of our strike prices, right? So the SPY is currently at 414. That's where it's currently trading at. Okay, on the left side we have calls here, on the right side we have puts. So I'm going to look to sell a put that is at a lower price than what the shares are currently trading at, right? Okay, so you can do this in how do you choose, what strike prices to choose? That's really up to you, okay? Because what we're going to bet on in order to collect income is that these puts expire worthless and we keep our premium. That's how we're generating income. We're selling these contracts, someone is paying us a premium for them, and then they're going to expire and we keep the premium. Now I'll get to what happens when they expire in the money in a second. Don't worry about that for now. But what I'm going to do is I like to choose this delta column here. So the delta, if you want to think of it very simply, is basically you can look at your standard deviation charts. So you have price, you have one standard deviation of movement, 34% chance on each side, 2 standard deviations, 3 standard deviations, right? So price is generally going to stay within 1 or 2 standard deviations of price. So if we want to collect a good bit of premium and still stay away from price, we can go with maybe 1 standard deviation away, which is around the 30 delta. That's just to keep things simple here. That's basically what delta is telling you, right? So around the 30 delta. Now what I'm going to do is I'm going to sell 10 of these contracts. So, and of course you can do more or less. Each contract represents 100 shares. That's why I gave the number 400,000 before, is because 10 contracts, each contract representing 100 shares, is 1,000 shares. So you have to have enough cash to buy 1,000 shares of the stock, which would be about $400,000. And so that is what is backing the sale of these contracts. Now, if you're starting to worry about what's the worst that can happen with this, don't worry. I'll get to that in a moment. But if we go ahead and we sold these contracts, what do we have? Okay. So we have our profit, if these expire worthless, is $4,920. Now these expire in a month. So right there, if you sell these contracts and they just expire worthless, so what that would mean is that the market either stays the same price or goes up or even comes down a little bit, as long as it does not close below this 404 strike price that you're selling it at on June 30th, then you keep all of the premium. Then your $400,000 for the month of June generated you a passive income of nearly $5,000, right? Now, this max loss here, I know you're looking at that. That's not really a max loss. I will explain this in a moment, so don't worry. But this is what we're going to do. So we're going to sell these contracts and then just wait, right? So market does its thing. At the end of the month, we either expire worthless above 404 and keep all the money, or what happens if the market goes down and it goes below 404, which is the strike price we sold at? What happens then? Do I lose all my money? No. What is the options contract? The options contract is, because you sold it, you now have the obligation to buy 1,000 shares of SPY, the S&P 500, at the strike price of 404. So think about what you were going to do with your money anyway. You were going to just buy and hold. You're willing to buy the S&P. And you could do this on any stock too, by the way. We're using S&P today to keep it simple, but you could do this if you want to buy Apple stock, if you want to buy Tesla stock, if you want to buy NVIDIA. You can do this strategy on those stocks. The main thing is that you do it on something that you would be buying and holding anyway, right? So worst case scenario, market goes down. Now we have to buy 1,000 shares of the S&P. Okay, well that's great. Now I'm back in the buy and hold. So now these shares go in the money, and and I buy them. So now I own 1,000 shares of the S&P. Okay, so great. So I made a little bit of a passive income until the moment that one of these, goes in the money and I have to buy the shares. Then now what? Then now I just own 1,000 shares. What do I do then? Okay, well, you could just hold on to them, which is what you were going to do anyway, buy and hold. Or, this is the other part of the wheel, you can go over to calls. Now, in order to sell puts, we sold what's called a cash secured put to start with, because we just had cash, but we had enough cash to buy the shares if the puts went in the money, right? To sell calls, you have to now own 1,000 shares, and you're selling calls against your shares. So that works exactly the same way. So I now own 1,000 shares of the SPY, and maybe I want to sell calls against my shares. So I'll stick with the 30 delta again, 1 standard deviation move. Boom. So I'm going to sell now 10 contracts representing 1,000 shares at the 424 strike price. And these are calls. So what happens with that? Okay. Now I will generate $3,230 at the end of the month, assuming that these calls expire worthless. Basically, if the market closes below 424 by June 30th, when these contracts expire. Now I know you're looking here, the max loss is infinite. Well, that's just what it's saying here. Let me explain this. Okay, so best case scenario, you keep your 1,000 shares, and you also get $3,200 for selling these contracts, and you just get to keep that money. That's your passive income for the month. All right. And by the way, if you're wondering, yes, there is a little bit more premium on the put side than the call side. That's just kind of the way options are. There's something called put skew. It's just there's a little more volume on the put side, so you get more money over there typically. But that aside, what's the worst that can happen here? You're taking my large accounts, Dalton. You're taking my $400,000 retirement account. What's going to happen? What's the worst that can happen if these go in the money? Okay, well, here's what happens. Because you sold the contracts of your shares that you own, now you have the obligation to sell all 1,000 of your shares at the strike price of 424. So you sell your shares for 424. Well, hold on a second. Now let's think back. What did you buy those shares for? You're going to sell them. You're going to be forced to sell your shares at 424. Well, how much did you buy them for? Well, if you were selling puts, you bought them at 404. We sold the 404 puts earlier, right? So we bought at 404 and sold our shares at 424. So we made a profit on our shares, right? Isn't that awesome? So this is also great to implement for your investing too, because if you want to buy the market, but you think the market's too high, you can sell puts, collect your premium until the market comes down to the price that you want to buy it at, 404. Okay, and then you buy it at a lower price than what it's trading at today. And then if you get called away on the shares, well then by selling calls, that means the market went up. So not only, think about this. This is how we generate passive income. Not only did we use our cash to generate passive income by selling options, but in the worst case scenarios, when we had to buy the shares and we had to sell the shares, we made a profit on that trade. Bought at 404, sold at 424. You can't beat it, folks. So this is called the wheel strategy. And it doesn't take much know-how, right? I mean, you should know how to do this just from watching this video, hopefully, if I explained everything correctly and as simply as I possibly could. Hopefully, maybe watch it again if things went over your head. But we didn't have to, go to school for years. We didn't have to study trading for, years and know all these things. And all we did was learn a few things about calls and puts. And now we can generate passive income from the market on our large accounts. So hopefully this video was helpful. Please like, comment, and subscribe to the channel. If I missed anything, let me know in the comments below. Hopefully I can answer questions, be interactive for you. If you are into day trading, I do have a couple links in the description. One is for my daily pre-market newsletter that has my analysis sent to you every single day. It's free. The other is for Apex Trader Funding. So if you're into day trading but don't want to risk all your money, that's a very smart thing to do. Keep your money safe and get on with Apex Trader Funding. You can use the link there too. So this is Dalton Grados with Grados Capital. I'll see you guys next time.